So I think people have arrived, and those that are interested in this topic. And so welcome to a session of the RPN, Research and Policy Network, that deals with European financial architecture. This is the slot this RPN has in this Paris event. The RPN itself is run by Elena Caletti, who is sitting here, and myself. I'm Jan Krahnen. And we have been doing a program over the year, and in a way this is now the culminating or the final event. And to give you just some ideas what we have been doing, we have been working on climate finance and publishing a Vox EU piece on giving a perspective where finance can contribute to the climate debate. We have been doing a number of things on SVB, on the Silicon Valley Bank, and the crisis there was obviously a core event for this RPN, banking crisis, and in a way today is also related to this topic. And the last and the third thing we did over the year and still ongoing is trying to write a report on the Ukraine financial architecture. So what can be said about reform aspirations related to the financial system in Ukraine, given the current situation and the future, I would say, challenges. And that's still underway, and we hope that we can present all this in March in a launch event. So today, we want to basically look a bit into the resolution process. That is always a matter of debate all over the world, whether you look into the US or in Europe or outside Europe, in other countries like Switzerland. How do we really do resolution well? What are experiences of the last year? There were several events around. We had a year full of bank runs that we haven't had for quite some time. We have seen hectic resolution efforts by resolution agencies. And of course, the question that one could ask is, in what sense were these interventions successful? Are there any lessons we can draw from it? And what is success anyway? So how would you measure that? One aspect that caught the eye of the observers, including Financial Times in some detail, is the high profits made by acquirers in arranged marriages during a crisis weekend. And are these profits too high or just about right? Do we have to expect that, and so forth? So that's basically the stage that I want to set in the background for the presentations of today. So in a way, the guiding questions for today: what should supervisors do in a crisis? How to judge recent experience in the US, UK, Switzerland, and other places. So this session today will have two short presentations. They are both based on a paper that they have been writing with the same title. So in the upload to this session, you will find the title and the number, or the paper being numbered, so that you don't think it's the very same paper. It's not the same paper. These papers have been commissioned by EGOV, the Economic Governance and EMU Scrutiny Unit at the European Parliament, that prepares the Parliament for discussions of imminent issues. And that had been commissioned under the title, "Do White Knights Make Excessive Profits in Bank Resolution?" So we have these two papers being presented, and I say a few words on the presenters in a minute. And then we have two discussants, and the idea was we find discussants that can, from outside the inner academic circles, can have a look on what both these two papers have produced. And I'm very glad that we have very competent persons, which I will present in a second, that look both from the competition side, from the market infrastructure side, as well as from the supervisory resolution side on these developments. So the presentations will be by Huizinga from Tilburg University and Jonas Schlegel from SAFE. originally we planned to have Florian Haider here, but he couldn't come due to the strike in Germany that basically let trains and planes disappear simultaneously. And for the discussions, we have Benoît Coeuré from the French Antitrust Authority. Now I will say a few more words on him later, and Elke König, who was formerly the chair of the SRB in Brussels. Okay, so let's get started. I would like to introduce Harry Huizinga. So we will go from right to left, from left to right, from your side. Harry will start. He's a professor of economics and chairman of the European Banking Center at Tilburg University. He is a CEPR research fellow for many years and has been basically working a lot on public economics and banking. He was an economic advisor to DG Economics and Financial Affairs of the European Commission some time ago, and he has published extensively on bank lending and also on profitability, so actually exactly on these issues. So I hand over to you.
So thank you, Jan, and thanks to you and Elena for organizing this session. So in the European Union, we have the single resolution mechanism to deal with failing banks. And for this function to be performed properly, it's necessary that if you have a failing bank, that you can find an acquiring bank that's willing to take over this bank at a reasonable price. So if the price is too low, there can be excessive profits for the acquirer, and therefore less money on the table for the shareholders of the acquired bank or their other claimants, or more money has to be put in by deposit insurance agencies or by resolution funds. So that's all undesirable. So, as Jan already mentioned, earlier this year we saw 3 regional banks in the US that failed and had to be taken over by 3 other US banks. And in Switzerland we saw that UBS took over Credit Suisse. And then there was an article in the Financial Times that argued that the profits made by the acquirers in these cases were excessive, and they argued this on the basis of some accounting gains reported by the acquirers and on the basis of share price appreciation of the acquirers. So then the representatives of the Econ Committee of the European Parliament requested us to write briefing papers on this. And then the paper that I wrote with Atakan Berthe, it does the following. We look at some acquisitions of failed banks in Europe, and we see whether there are comparable gains for the acquirers. And also we offer some thoughts about what policymakers can do to try to reduce these gains. And I think later on in the discussion we'll probably get back to that as well. Okay, so following the FT article, you can have either accounting gains for the acquirer that you look at, or market-based gains. So we then have 2 variables. So first AG, that's the accounting gain, and that's the reported absolute accounting gain, which is sometimes called badwill, but then divided by the book value of assets of the acquired bank. And according to IFRS 3 on business combinations, this accounting gain in absolute terms has to be computed as the fair value of assets minus the fair value of liabilities and minus the acquisition price. So correspondingly, we have the market gain, MG, which is the increase in the market value of the acquirer, again, relative to the book value of the assets of the acquired bank, and the increase in the market value of the acquirer, that's computed using the excess return around the acquisition announcement times the pre-acquisition market value of the acquiring firm. So these are 2 different concepts, AG and MG, so they can differ obviously. And one can expect for one reason that AG is larger than MG, and that's because at the time that the accountants compile AG, they have more or less full information about the assets that have been acquired and also the liabilities. So there is less of, say, a risk discounting, so therefore AG can be larger than MG. But on the other hand, there are also reasons to expect that AG is less than MG, and that's because the accounting gain, it does not take into account the valuation of customer relationships which are acquired, possible synergy gains, say cost savings that can be achieved, and also it does not value an increase in market concentration or possibly an increase in the too big to fail status of the combined bank, insofar as we still can talk about that in Europe. So at the starting point, we looked at the AG then for the cases which were mentioned in the Financial Times article. So we have the 3 US acquisitions and the Swiss acquisition. And in one of the columns you see badwill, so that's the absolute accounting gain, which is in billions of euros. And for Credit Suisse, we see a figure of 27.1 billion euros. And that's, I think, an eye-watering number, which probably set off the Financial Times article. So then we deflate this by the assets of the acquired firm, so we get to the final column, and we see, well, for the 3 US cases, if you average it, AG was on average 2.6%, and for the Credit Suisse takeover, it was 5%. So then the question is, how does this compare to European cases that we've seen? So we have to look at a sample of EU distressed banks that were taken over. And we then look at cases which occurred in 2015 or later. And that's because in 2015 we had the initial implementation of the Bank Recovery and Resolution Directive. So we're considering cases that are subject to the same regime. And all of these cases, they are cases where the acquired bank underwent some official intervention. So in some cases this was a precautionary recapitalization. In other cases, the bank was simply declared to be failing, and there followed a regular resolution by the resolution authority. So these cases that we consider, they come from a list of cases of distressed banks that was compiled by the European Commission, published in this year, and in an annex, so you can look at all the cases that they found. So here then is some information on these European cases where we look first at accounting gains, that's AG. So at the column to the left, you see the bank that is acquired. The second column, you see the bank that is the acquirer. The next column, you see badwill. So that's the absolute accounting gain reported by the acquirer. And if you look at this column, you see that this accounting gain is negative in 3 cases. And particularly it's negative in the most important takeover here, which was the takeover of Banco Popular Español by Banco Santander. And you see there was a negative accounting gain of 248 million euros. And the other 2 cases were sort of minor takeovers, but the 2 more negative numbers. Then if you look at the mean value over these 10 cases of AG, it is 2.9%. So the 2.9% that, in my mind, is comparable to the average that we found for the US cases, which was 2.6%. And by the way, for the cases where the absolute accounting gain was reported to be negative, if you actually scale it by the assets of the acquired bank, and that's actually the next column in the table, you can actually round it to 0. So the negative accounting gains that were reported, where they were reported, were actually negligible relative to the assets of the acquired bank. So far, not much difference between Europe and the US. So next what we look at is MG for most of these same cases where we actually found information. So the first data column then tells you the absolute change in the market value of the acquiring bank. So this results from an event study, as indicated. And here it's interesting to look again at the takeover of Banco Popular Español by Banco Santander. And here we see that the increase in market value was positive. So Banco Santander, it increased in market value by about 1.4 billion euros. So the accounting gain was negative at 248 million, but the market gain is positive at about 1.4 billion. And so this can reflect some of the factors that I mentioned. So if you look at the annual report, for instance, of Banco Santander, they claim that there are going to be synergy gains, so cost savings, and of course it also could be that this new combination has more market power. So on the one hand, the resolution authorities did quite well by engineering a negative accounting gain, but still the market gain was quite positive here. As a byproduct of these various 2 tables that I showed you, one thing we did in our paper is to look at how AG and MG, how these 2 variables, how they vary with the relative size of the acquired bank relative to the acquirer. because this relative size issue is one of the variables that the resolution authorities can target or look at. So how does this work out? So we first look at AG, so the accounting gain, relative to the size of the acquired firm relative to the acquirer. So on the horizontal axis, you see the relative size of the acquired bank. So to the right, you have bigger acquired banks relative to acquirer banks. And the vertical axis, you see AG. And in my mind, there is a positive relationship here. So if you take over a relatively small bank, you are willing to accept a small AG. But if you take over a relatively bigger bank for you, you want to negotiate a big AG. So I think this reflects that if a smaller bank has to take over a relatively big bank, there's more risk, of course, and you see this reflected in larger relative accounting gains. So one message for resolution authorities then would be that they should try to tie small banks to bigger acquirers. So next, we have a comparable figure where now we relate the relative size of the acquired bank to MG. And here I think there's a clear negative relationship. So what does it tell us? It tells us that if you take over a relatively small bank, relative to yourself, the stock market rewards you. They think you're doing a great job. Because that, in our mind, that entails relatively small risk to you. Of course, the opposite case, if you take over a relatively big bank, then the stock market thinks you're undertaking something relatively risky, and they more or less punish you. So the message, again, also from this figure, is that you should try to tie smaller acquired banks to bigger acquiring banks. And well, you should notice that, you can notice that if you actually look at the two figures, that there's going to be a negative relationship between AG and MG, which is not shown, by the way, so I don't have a figure for it, but it's actually surprising to us that you see this negative relationship between AG and MG in the data. So now, what can public authorities do to make sure that there are no excessive gains? 2 minutes, okay. Well, one thing is to make sure there's enough information about the acquired bank available to the acquiring bank. Another issue, and that follows also from the literature, which has done some research related to this issue, and to increase bank competition among potential acquirers. That's the second issue to focus on. Now, in terms of additional information available to the market, well, there is already information in financial reports, but I think it's also important that there is already supervisory information available on a lot of banks in the EU through the EU-wide stress tests and also through transparency exercises. So the message would be, if you increase these samples, there's more information in the market, and therefore you probably can get a better acquisition price. Also, you need to optimize the flow of information between the acquired banks, the resolution authorities, and the acquiring banks. But that's, for us as outsiders, a black box, but maybe Elke wants to comment on that. Finally, there's the issue of how to increase competition among potential acquirers. So if you look at our tables, you actually see that all the acquisitions are domestic. And so why don't you see international resolution cases? Well, it could reflect the fact that, generally speaking, we see little cross-border banking in the EU. And so apparently we need to work on getting more of a banking union and eliminate barriers to international banking. The other issue is, again, that the resolution authorities have to properly do their homework. And one aspect is that if you want to do appropriately deep resolution planning, you have to consider sufficient number of potential acquirers. So you have to vet enough banks to see whether there are, say, barriers for competition or financial stability ahead of time. So you have to do your homework to make competition possible. As one aspect of this homework, I think one issue is that it would be nice if the resolution authorities on a regular basis, ex ante, consider whether they can actually implement a bridge bank option, which is possible. It's one of the options that the BRRD provides for. So that's the case where you have a resolution authority or another public body take over the failed bank for a period up to 2 years. So effectively, then increase competition because the public authorities are one of the bidding parties at the time. So perhaps that increases the bargaining power of the public authorities and therefore would elicit a higher acquisition price. So I'm wondering a bit whether this option is regularly considered to what extent. I think we have no information on this from outside the institutions. Yes, please.
Yeah, I think that's a value of this panel, that we can perhaps shed some light on the deeper thinking from the authority side. But before we go to this interesting element of our session, I want to ask Jonas, who is the co-head of the Policy Center at SAFE and a financial economist with a PhD from LMU in Munich, to present his start or the additions that he can make to the presentation that has been made. Jonas, I hope I'm now better. Yes.
Yeah, thank you for being here, also on a rather short notice. Yeah, exactly. So same request, same title, different authors. So this is joint work with Florian Heidag, who cannot make it today, and Tobias Tröger and Mark Warnburg. And luckily, different presentation. It's almost complementary, I would say. We solely focused on the 4 cases in 23. Just as a reminder, so Credit Suisse took over UBS, Signature Bank was acquired by Flagstar Bank, a subsidiary of New York Community Bank Corp. Silicon Valley Bank was acquired by First Citizen Bank, and First Republic Bank was acquired by...
I can do it.
No, I can do it. Yeah. So, and the question was, did the 4 acquirers, so-called white knights, make excessive profits in bank resolution? And as you already heard, the starting point was an article from the FT, and with the title, The 44 Billion Bank Bailout Bonanza, and the subheader, you can read the deals of the century. So they had a clear opinion on this. It was excessive profits. How did they calculate these 44 billion, which is a lot? So what they did is they calculated the negative goodwill, so-called badwill, which then presents the gains for the acquirer. It was already explained. And let's have a look at this accounting-based approach in the current macro environment. So look at the stylized bank balance sheet before interest rate increases. On the asset side, you have $100 of bonds. On the liability side, you have deposits, $80, and the rest is equity, $20. If now the acquirer takes over this bank for a price of 0, the accounting gain would be the equity, which is $20. Now you see the interest rates increasing, and let's say these bonds are held to maturity, so not marked to market. So finally, the bank has unrealized losses of $20. Nevertheless, as they are not booked mark to market, equity is still $20. So accounting gains are still $20, but if you look at a fair price, it should be rather around 0. And this is why we say, especially in the current macro environment, accounting-based approach is misleading due to unrealized losses and discretionary decisions by bank managers, which are not incorporated. Okay, second approach, how to calculate profits, is a market-based approach, and here we make use of an event study. We calculate the cumulative abnormal returns for the event window. The FT also showed the price performance of the acquirers. Nevertheless, it's important that acquisition of failed bank might relieve stress and reduce uncertainty within the banking sector, and therefore it's important to calculate abnormal returns against the bank benchmark. So let's have a look at our results. These are the results for First Citizen Bank, which took over Silicon Valley Bank. On the left-hand side, on the left-hand side, you see the cumulative abnormal return for the First Citizen Bank, and as well for 2 selected bidders, as the takeover in US is done by the FDIC via auctions. So this is why we also have losing bidders. And you can compare it, and we see astonishing high cumulative abnormal returns of 68%, while the selected bidders fluctuate around 0. On the right-hand side, you see the stock price performance gives a similar picture, right? I mean, it jumps in the beginning after the event and then continues to outperform the other bidders as well as the bank benchmark. So for the UBS, it's a bit more tricky. The event window is not that clear. If you remember, that was a chaotic weekend. On Monday morning, it was not really clear. There was a lot of uncertainty. For instance, for the write-down of the cocoa bonds, was it legally allowed or not? So we try to be as transparent as possible. So you see on the left-hand side the daily abnormal return for 1 week, and then on the right the cumulative abnormal return. The cumulative abnormal return is 4.1%. Nevertheless, like I said, it's difficult to estimate a clear event window for this takeover. Also, when you look on the right-hand side where you see the performance again in green, you see the UBS, and there's no outperformance for around 3 months, and in August, suddenly a big outperformance is taking place. And what happened in August, UBS terminates all federal state guarantees and presents solid Q2 figures. So in general, it might be that it took a long time for shareholders to fully understand the deal with Credit Suisse. Finally, yeah, thanks. Yeah. Finally, I think it's necessary to bring the cumulative abnormal returns into perspective. 68% for First Citizen Bank is a lot, but when you calculate the cumulative abnormal return in dollar terms, which is done by multiplying the cumulative abnormal return with the market capitalization of the acquirer, the picture is different. If you look at won't work. The cumulative abnormal return for JP Morgan is only 2.8%, while the bank is so big that the cumulative abnormal return in dollar terms is 11.2 billion, which is now the biggest among the four. On the next line, you see the FT accounting results, and compared to our cumulative abnormal return in dollar terms, we see it's FT is roughly double. So they end up, if you remember, for 44 billion, and we find around 20 billion in total over all four banks. And as a final step, which is quite interesting, I think, is we also look at the total assets acquired. And when we now divide the cumulative abnormal return in dollar terms by the total assets acquired, we receive a kind of a discount relative to acquired assets. And for the US cases, it's quite interesting. They fluctuate around 5%. Right? We have 3 totally different takeovers, but the discount is fairly similar. Is that insanely high? No. Is that excessive profit? I think this is up to debate. And finally, the UBS, like I said, it's tricky. The figures are fairly small, but maybe an event study is not the right approach to access gains for UBS in terms of mergers. Okay. So what do we recommend? We recommend transparent auctions as they are done in the US, but maybe we should not see the US as a role model, or the FDIC as a role model here. Maybe this is also up to discussion. Yeah, with a sufficient number of bidders, and this should be preferred to negotiated bank sales. Resolution authorities need to prepare better and earlier for the auction, so the time argument is key. And finally, not only significantly important banks, but also non-significant banks should be sold by bank resolution authorities. Thank you.
Yeah, thank you, Jonas. So I want to hand over to Benoît Coeuré, who is, as I said, the President of the French Antitrust Authority since January 2022. He had been the head of the innovation department at BIS before, and also the president of the payment and systems and market infrastructure theme and department at the BIS for more than 6 years. He was a member of the board of ECB. That's where we know us from the Frankfurt period, and had a prior career in the French Treasury. And I could say many more things about you, but I think this is all enough to make clear that with you we have here an authority that may say something both from the financial infrastructure side as well as from the competition side on the way we deal with this issue of resolution and finding a good way forward. So the floor is yours. And you can move it with your.
Okay, thank you, Jan, and thanks to you and Elena and Elise for setting up this discussion on bank resolution, which is I mean, we all know that banking union is kind of a half-baked project, or has been left in the middle of the river by politicians, and banking resolution is one of the issues, not the only one, unfortunately, but one of the issues that certainly needs further thoughts. Also, now that we're coming, it's almost 10 years after BRRD was agreed, well, maybe not fully implemented, but agreed, and so it's time also to take stock, which the Commission has been doing earlier this year, but there has to be a political discussion about what to do, and this is a very useful input into that discussion. I enjoyed very much reading the papers. There are lots of good recommendations. I fully subscribe to everything that's about better preparing the resolution, better information, etc. So I'm going, of course, to be picky and pick the points where I'm a little bit less in agreement, because I guess that's my job here. But that doesn't mean that I mostly agree with the papers, and they raise a very important points. So this we don't need, obviously. What I'm going to do is very shortly is first to discuss a little bit the notion of a resolution cost and whether resolution authorities should minimize resolution costs and which definition of the resolution cost. And then say a word about resolution tools, not that deeply, because I'm sure that Elke is so much more knowledgeable about that than I am, but I will still say a few words about that, and then say a few more words about whether white knights should be large banks, where of course my competition angle will come in, and so you can guess what the answer will be from a competition standpoint. On resolution costs, I think the first thing I wanted to say is it's pretty obvious, and is that there will always be a resolution cost. So it's good to try to minimize it, which the authors are making a good job at, but there will always be a resolution cost because information is so highly asymmetric in a resolution. It's a very risky project to take over a failing bank. You don't know what's in the books, so there are ways to, of course, to improve information, but you'll never be fully informed. Even probably the reason the bank fails in the first place is that they don't know themselves what they have been doing. So it's not clear where to find the information. And that very high risk profile justifies an excess return, which has to accrue to someone. But you want to go away with the excess return. It's inherent to the situation. Also, the market for failed banks is not a competitive one. So there are ways which are discussed in the papers to make it more competitive, to broaden the bidder pool, for instance. But it's never going to be very competitive. You always have only a few possible bidders for a given failing bank, and so you have lots of market imperfection there. And finally, it's not only a kind of a partial equilibrium issue or a discussion between the resolution authority, the failing bank, and the acquirer. There are lots of systemic spillovers, which the resolution authority has to to be mindful of. Including also in terms of possible funding costs and liquidity shortages that can be also triggered by the resolution. So there are kind of extra. There are lots of considerations outside of the deal which the resolution authority has to be mindful of. And so how much is too much in terms of the resolution cost? And here I would challenge a little bit what the authors have been doing. First, I'm not sure that the upfront measure or the point-in-time measure of the resolution cost is the best one, because a lot will happen after the resolution. There will be integration costs within the new group. Can be very costly in terms of IT, HR. There are lots of practical issues there. Merging legacy IT systems, we all know that it's very costly and it takes a long time. And of course, but that was that was pointed out by the authors. You can have lots of unrealized losses in the portfolios that will have to be recognized later. That does not recognize point in time from an accounting basis, but that will be recognized later. So one might argue that the market-based measure, the stock market-based measure, is better from that standpoint because it's forward-looking by definition. But I'm not very confident in the ability of the stock market to value all these costs, future costs and future losses. So I wouldn't put too much money on that market-based definition either. So what I would say, and that might be very naive, but I want to throw it in the discussion, as an authority, I would say that for me, the best measure of the resolution cost is whether the risk-weighted capital ratios of the acquiring banks have increased after resolution, because you want to take account risk, right? The approach has to be risk-weighted. So if the acquiring bank is better, all things equal, of course, is better off in terms of its risk-weighted ratios after the resolution, then that means that probably risk hasn't been remunerated properly. But okay, that's a suggestion I'm making. And of course, you won't know it immediately, so you will know it only after some time. Second set of considerations are more in terms of policy or in terms of from a kind of normative standpoint. Should resolution authorities minimize the resolution costs? I would say no. I say minimizing the resolution cost is absolutely not a resolution objective per se. It's not even a resolution principle, so there are lots of other things that you have to keep in mind when you resolve a bank. First of all, you have to I think the key social mandate of the resolution authority is to protect taxpayers and by extension to protect the resolution fund, which is not taxpayers but the industry as a whole. And so what really the loss function of the resolution authority should be about minimizing the cost for the resolution fund and the taxpayers. I don't think the resolution authority should care a lot about shareholders and creditors, and I have no sympathy for the shareholders of the failed bank. They are responsible for the failure, so they should pay, full stop. So I don't care that much about how much they will pay. So that's the first thing. And second, maybe another remark is that it's a lot. The discussion here is a lot about the BRRD. Well, even though one of the papers is about US banks, but negative goodwill or badwill is not specific to BRRD resolution. We've seen it in US cases and in the Swiss case, as was shown. We've also seen it pre-BRRD. I remember the sale of the Greek subsidiaries in Cyprus to Piraeus back in 2013, which was pre-BRRD. Elke, you certainly remember very well. Yeah. And there was a huge negative goodwill for Piraeus. So that's kind of inherent to all resolution frameworks. I'm not sure that one framework can be that much better than another here. In terms of the instruments, as I said, I'm not going to be very long. My message here is you need a combination of tools because all resolutions are different. And so the bridge bank, of course, should be part of the toolbox. I'm not sure it's such a panacea because it does involve costs as well, because you need to set up the bridge bank and to operate it. You need for a mix of tools. You need also bank transfers, I mean sales, and you probably need to do a little bit more of open bank bail-in. That is, you keep the bank open and you sell part of it and you bail in and recapitalize what remains of it so that you can keep one part of the bank up and running. And the reason I'm saying that is that it's also a negotiation, and you want to maximize the negotiating position of the resolution authority, and for that, the resolution authority should have different options. You should not tie yourself to one particular option. You should be able to threaten the shareholders of both the failing bank and the acquirer to shift to another option if you're not happy with their proposals. So you should have this broad set of options. And by the way, there is a very nice BIS, Financial Stability Institute working paper that came out this week on options in resolution, which makes the pros and cons of different options very nicely. And finally, I think there is one particular circumstance where the choice is very much restrained, and that's when the failure is triggered by a liquidity crisis or liquidity stress, which is not the general case, but it happens. and it will happen in the future. Why will it happen in the future? Because we haven't come yet with a proper solution for providing liquidity in resolution. We've tried. Elke and I, we've tried hard when I was at the ECB, and we failed because governments didn't want to provide a backstop to liquidity in resolution. So basically governments said, okay, well, it's good to have liquidity in resolution, let the ECB provide it, and let the ECB bear the risk, which in our view was actually illegal. Yeah, Elke would have been fine with that, but for the ECB, that was illegal and not the proper assignment in the system. So, I mean, Elke can comment on that. But what I'm saying here is that government treasuries should have skin in the game here, because if there are losses to be borne, or the resolution fund maybe, or the industry as a whole, but you cannot leave the full burden of providing liquidity in resolution to the central bank, because there can be losses. So that's where we are now. But the result is that there have been and there will be other liquidity triggered resolutions. And when the resolution is triggered by liquidity, it's very fast. And of course you can prepare better for it, which the papers, which is a point that the papers are making, rightly so. But when you're there, you have a few hours and you don't have time to organize an auction and to go around and then talk to bidders and so on. You have to be very, very fast, meaning that probably that's going to be reflected in the resolution cost. The resolution cost will be higher because you had fewer options. So my message here is take care of, please come out with a proper framework for liquidity in resolution, because that will have a positive impact on the resolution cost as well. Finally, and I'm close to concluding, I think there are, I've read the Commission's proposal on crisis management and deposit insurance, which came earlier this year, the so-called CMDI proposal. And I think there are good points in terms of the process. Particularly, it's also about expand the range of resolution tools, the point I've just made. But it's also about coordination between the resolution authority and the bank supervisor, which is a very important point to make. I think probably I would have liked the papers to kind of stress it more, that there should be early engagement between the resolution authority and the supervisor, and the resolution authority should have powers to call the to prevent procrastination by the bank supervisor, to put it very simply, which we don't have today. And again, that's something that increases the resolution cost. If the supervisor procrastinates too much and wait for too long, the situation will be even worse when resolution comes. So here you need also a better engagement between the resolution authority and the supervisor. And finally, there can be lessons to be learned from other resolution frameworks. So my personal experience is with market infrastructures, where when I was in CPMI, we launched some work on CCP auctions. What's the best framework to auction assets when a CCP member fails? And again, it's a lot about preparation, information, governance, etc. So there can be lessons to be learned here. And also there is a huge experience in the central banking community around collateral repossession. What do you do with the collateral of a failed bank? I mean, we had that experience after the Iceland, volcano event. And so there is lots of good practices in the central banking community on how to repossess collateral, which maybe could be used here. What I also wanted to say is that there are many other issues with the notion that failing banks should be acquired by large banks. So that's, of course, addressed in the papers. But there are, in fact, other reasons why large banks could be preferred as white knights, because they have the available resources, both in terms of capital and in terms of liquidity, which is very important, or collateral, available collateral to bridge the funding gap after resolution. Because they have more diversified risk profile. So a small bank with a kind of more specialized risk profile might not be able, in terms of risk diversification, to buy a failed bank, while a large bank with an already diversified risk profile might be better able to do it. And also, since resolution has to be fast, the large banks have they are insiders, right? So they have the institutional connections or the political connections to be, they will be called first, right? So that's more a kind of sociological issue, if you want, but that's a fact. And so all combined together, all these reasons why large banks are the preferred options in a resolution, I think are quite problematic from an antitrust standpoint, from a competition standpoint, because that will lead to reinforce market dominance. And that's not about the BRRD. BRRD is about state aid. BRRD is about protecting the taxpayer. But even if BRRD would be fully enforced, there would still be an antitrust issue because a resolution would reinforce concentration in the market. And by the way, it also increases moral hazard because when there are fewer banks, and I think the Swiss case is, I think, a perfect example of that. If you have n banks and you're left with n-1 banks, they're all going to the acquiring. You reinforce the competition, the possible competition issue, and the acquirer gets even bigger. So what happens if the acquirer itself fails? What's the next point? So in some cases, you might only be shifting systemic risks in time to the future because you're creating more systemic risk in the future because the acquirer will be even bigger. So there is an intertemporal trade-off here. And we know that politicians are not that good at handling intertemporal trade-offs. So the resolution authority has to internalize it, but that's a big burden on the resolution authority. Okay. And so what happens here, of course, the competition authority can stand in. I think we will always grant some kind of a temporary waiver because it's urgent, but then the competition authority should retain the possibility to investigate the deal, the acquisition, and possibly call for remedies, that is divestitures of the acquiring banks. One open question I have is, are there ways to internalize a little bit better the antitrust issues before the resolution point? For instance, when selecting the bidder pool, and what I've heard today in terms of broadening the bidder pool goes in the right direction. Possibly foreign banks acquiring the failed banks, possibly having more investment funds, that is non-banks being kind of eligible to buy the failing banks. That would go some way to alleviate the competition issues. And finally, and that's a very general word of conclusion, I think there is a long story of difficult relationships between central bankers and competition authorities because you have financial stability on the one hand and competition on the other hand. To put it in kind of pedantic way, you would say that central bankers favor ex post efficiency while antitrust authorities favor ex ante efficiency. And maybe resolution authorities are also on that side of ex ante efficiency, I don't know. And so there is a history of very difficult relationships, and the bank industry being a no-go zone for competition, I mean, in lots of countries. That has changed because central banks have woken up to too big to fail. So now they understand that big is not necessarily more stable. Also, central bankers, I think, have warmed up to the merits of innovation. And if you want technological innovation, you want newcomers to disrupt the incumbents. And for that, you need competition. I think PSD2, the payment directive, is really a success story of opening a market and bringing innovation. And I think central banks have understood that. And then you have maybe that's incidental, but central banks and antitrust authorities are united in one concern, which is concerns about big tech companies stepping in financial services. So that's something that unites now central banks and antitrust. So I stop with this.
Yeah. Thank you, Benoît.
I just want you to have a look at this picture, which is the kind of the end game of our discussion.
Yeah, this is a nice outlook of what's ahead of us. So thank you, Benoît. You really delivered on exactly what I was hoping for, namely that the picture gets a bit broadened and we see that the huge complexity that is involved with actually doing such a resolution exercise. And I mean, without going into the discussion right now, I would hand over to Elke König, who has been doing this for so many years. She set up the SRB basically from the start and headed it for 8 years. I think she had all the experiences now to tell us how much of your time was devoted to preparing such an auction and securing the liquidity in such a case. Or is this even today still a surprise when it happens and you are in a hectic mood to find new solutions?
this goes without a presentation, but let me try to react. And first, thank you for inviting me. And I was thinking, speaking after Benoît is always interesting, because you can already tick off of what you wanted to say, what he has already all touched on. But let me try to structure my answers. I think both studies are very interesting, but they also show, I would call it, the problem that looking at definitely accounting numbers, but also looking at economic numbers and looking at a very short period of time, you might not get the full picture. We were recently thinking of a German case long ago. Everyone applauded a purchase or sale of business or taking over, whatever you want to call it, until this gift kept on giving during the financial crisis. Mm-hmm. So I think one point first is don't just focus on the numbers today, but really focus also on the risk. But let me look at what we are looking. I think, and this was in both presentations, the recommendation to enhance transparency, to prepare for an auction process, and I would immediately tick that box. In our European framework, to be very clear, for us, the counterfactual to resolution is always insolvency, because you're talking about a bank that's failed or is supposed to be failing. So you're not talking about a variety of answers. It's either resolution, or if there is no reasoning for resolution, well, then it's a partially piecemeal, different countries, national insolvency. So European resolution versus national insolvency. And I think we are missing here also a bit the point when we talk about transparency, auction process. Let's be realistic. Benoît mentioned it. Not just a few cases, a number of cases are basically banks that run out of liquidity. Mm-hmm. So the time span to find a solution is now. It's not, let's think about a solution in the coming weeks, let's make it a very broad auction. So what you're doing as a resolution authority, but I'll come back to preparation afterwards, is that you think about inviting to the auction, but also being open, because when you name that the bank is going into resolution, everyone who is interested could, in principle, take up the phone and say, I want to bid in this process. And as a resolution authority, you are really sometimes even desperate to find willing buyers or willing parties to make it a competitive process. But you also need to find a speedy solution to preserve value, and in particular to preserve financial stability, an issue which was quite to the forefront, I think, for our US colleagues earlier this year, to stop the market getting nervous about the next and the next bank. So preparation, of course, depends on the one hand to the time available. You have cases that loom, and you can already think about what if something happens. Make sure that there's no procrastination by the supervisor, so push them to say, well, where are we going? But you also might have a case where, and in particular in the case of liquidity, where it comes at very short notice. Now, in the end, and this is a bit perhaps going back to the price, it's always nice to consider that you know the fair value. But in a market transaction, the bidder defines what the fair value is, because you need to find a willing bidder for a given price. So, as I said, in our EU framework, we have as resolutions counterfactual national insolvency procedures. We are preparing increasingly, but there's also a difference between an 8-year-old organization and a 90-year-old organization. We are, the FDIC, we are preparing for different scenarios. So you have, of course, the open bank bail-in, which basically means you try to recapitalize the bank out of the Emerald, and then to put it back to the market and restructure piecemeal, stepwise. You have sale of business. If you find a willing buyer that might fix the problem the next day. This was the Banco Popular transaction. You have a bridge bank, but I'm always a bit no. The bridge bank is a nice tool to buy your time. First, you want to open the bank the next day. So if the bank is illiquid, where to get the liquidity to open the bank the next day? Second, if you have a failing bank and you put it into a bridge bank, you need to immediately address the root cause of failure. You can't wait for the coming time. Then you have a nice gift that keeps on giving and you are destroying further value. So for me, speed is also something that preserves value in resolution. If you wait longer, you will probably lose franchise value and the like. So this is the one thing. But of course, all of this needs, and third, sorry, I'm a bit disorganized now. Third one is, when you look at the EU framework, there is kind of a way to keep you accountable. And this is what's put into the BRRD. Within any resolution, you need to have an independent valuation. You need the independent valuer first to give you basically the fair value assessment. Now, any decent independent valuer will give you an assessment which is not a point. It's a range of values because of all the uncertainty. But afterwards, and I think this is even more so because resolution authorities have quite wide-ranging powers. Afterwards, there has to be a counterfactual valuation, which says in resolution, this was the outcome. What would have been the theoretical outcome in insolvency? So, because this is then defining whether you have treated shareholders, bondholders properly, or you've taken them for a ride. And it's perhaps good, at least I was very pleased to see that within the case of Banco Popular, recently the court decided, first round only, that the valuation 3 for Banco Popular that was done by the valuers was adequate, and there is no need to basically refund or hold harmless the bond holders, respectively equity holders. Nevertheless, and I think this is the most important part, is you need to prepare for one thing in particular. All the GSIPs have a data room for whatever purpose because they are constant issuers of bonds and the like. A number of the smaller banks probably have not prepared a data room. So if you go into resolution, if you're getting nervous, this is the most important part because this is the only transparency you can provide to potential bidders to open up a data room, even if you then tell them you open it up for 24 hours because you need the bid. Then keep in mind we have a moratorium for maximum 2 days to basically buy us time in Europe. So this is for the moratorium, for the data room that needs to be prepared. And of course, and Benoît, you talked about it, you could see from the procedures in the US, not just in March, but it's their general procedure, that they asked for bids and they asked for multiple bids if need be. So the potential buyer can say, I take it all, no guarantees, and this is my price. But if I'm allowed to carve out this, if I get a guarantee there. So what you could see, and I think in the last, in March, it's public information of the FDIC, they had more bids than bidders. So that there were different. This means, and this is something where we, I think, all have to work on, that you need to then evaluate the various bits, and if you are left with some, I would call it leftovers, then of course you need to manage those leftovers. There I'm fairly confident that within also the European context this would be possible. Nevertheless, our first attempt was always to try to sell it without any reps and warranties, so that we had finality in those deals. If you can achieve this, this is probably also for financial stability better. Benoît mentioned already liquidity in resolution. We've tried all kinds of ways, but even the ESM backstop is still left. So, and last but not least, two comments. It would be good to have more international bidders. But you're talking about a failing bank, and in most cases, if a bank is failing, the only ones that have at least a business case in acquiring are national banks that can merge it into their operation. If you don't have a foot on the ground, this wouldn't work. And second, and this is perhaps more for the lawyers to think about, the SRB as a resolution authority is not the receiver in the US sense. We are the resolution authority. If we can't find a solution, we hand it to national insolvency procedure. And this is different to what the FDIC does in their work, because they are to that extent, I would call it now, one-stop shop. And I would stop here because I think there's a lot to be discussed.
Yeah, there's a lot to be discussed, but we are running
too big
out
to
of
fail.
time, unfortunately. Yeah. So this is, I think these were great inputs, and if I think of the process of writing these little papers, it would be great to have this before, actually, because that's a much broader view, I think, of these things. If I can summarize what keeps in my mind from this discussion, is there a willingness and is there an ability to have several bidders in such a moment, right? And there are very many reasons that this, if you wait for this event to happen, the answer is no. Neither is there a willingness, nor is there the ability to have several bidders. So this all needs preparation. And I think this could be a lesson also from your reports. One needs to prepare for that event also technically. I didn't know that the data room is permanently there for the GSIP, so I heard that and learned that. I thought that would be one lesson. We need data rooms continuously fed and that are basically accessible so that there's no time elapsing in such moments, so that is existing. But you maybe, we have always been discussing almost from the European side, although the data are mostly exactly not from the European side. It's Switzerland plus 3 US banks, where the process is obviously very different. Also, the aspect of receivership is very important. And of course, one reform idea could be to make the SRB or whatever the construction could be together with SSM to be more forceful, also to be able to do such a process. So since our time is out, but we have such a fantastic auditor, I would like to have one round of very brief questions from the people here. We collect that, and I don't think we have much time to respond, but okay, let's start here. Nicolas was first. Yes. Yeah, there's a microphone here, and I'm so sorry for the organizers, but it's lunchtime, so maybe 5 minutes we have all in all for this issue.
Nicolas Véran at Bruegel and Peterson Institute. Two questions, one for Benoît, one for Elke. To Benoît, you said the SRB needs authority to prevent procrastination by the supervisor. My reading of the SRM regulation, or maybe that's the BRD, is that they have that authority. They can declare a bank failing or likely to fail on their own. So it's, from a legislative perspective, very similar to what exists in the US with the backup supervisory authority of the FDIC. And therefore, I would like you to explain a bit more what kind of legislative improvement you have in mind, because in my view, it's been more a question of practice than of legislation. To Elke, I mean, we won't have the time for that, but still, I would be interested, specifically in the case of Sberbank, which you and I have discussed before, and I think was very revealing, to understand better the division of labor between the National Resolution Authority and the SRB for that bidding process when you have a national entity, which was the case in Slovenia and Croatia? Who exactly was looking for bidders, and how did the national and the SRB level coordinate? Thank you.
Thank you. You can just hand over to the person in front of you.
Yes, I'm Ferdinando Giuliano. I'm UniCredit and a trustee here at CEPR, and I'm speaking on personal capacity. I have two questions for the authors. The first one is, when are excessive profits excessive? Because my impression is that the first paper says that anything above zero is excessive, and the second paper says anything above the market index is excessive. And the question is whether that's the right measure, because after all, as Benoît said, the banks which are acquiring are taking risks and will probably want to be rewarded somehow. Second point is whether these kind of excessive profits are a problem from a social point of view. Because the paradox here is that if you have some excessive profits, then you'll have bidders. If you have no excessive profits, then you have no bidders, and you end up with one less option. And my question then is whether the excessive profits we should be looking at is the subsidies which governments provide to some acquiring banks, and there have been some in some of these cases, and how they compare to an alternative where, you know, there was bail-in or something like that. So whether that's the excessive profits we should worry about, as opposed to a transfer of resources from, you know, bondholders and shareholders of a failing bank to bondholders and shareholders of an acquiring bank.
Yeah, very interesting question. Yeah, thank you. So there's Javier and Elena.
Thank you. It's more of a comment than a question. It's a question on competition and how to attract international bidders, in particular in the Eurozone when there is no a failing bank. I think this is wishful thinking today. So because the banking union is not complete, there are different legislations. It's not only the potential complementarity, which is true, of the networks and the savings costs. I think, for example, in the case of Popular and Santander, I think it's clear that a different bidder than Santander would have been better for competition. I mean, so that's, I think it's a no-brainer, particularly given the Popular's clout on small and medium-sized firms, right? But was this feasible? Probably not. But this is because of the lack of completion of banking union.
Steen, then okay.
Yeah, very quick, because in some sense, the empirical work that both of you have done, you can tell a little bit more the question that was asked before, whether there was excess profit due to the government subsidies, and you didn't seem to explore that, but why not? Was there money left on the table by the government?
I have instead two short questions. One is, Benoît himself said, I don't care about the bail-in because anyway they have contributed to the failure and therefore we can just bail the creditors in. On the other hand, as Elke also said, we need to make the no creditor worse off principle. So I was wondering whether the fact that we are giving excess profit, whatever we want to define them, to the acquirer actually can be in contrast to the bail-in and the no creditor worse off principle. That's the first question. The second, that is more a comment. Many years ago, I did a lot of study on the institutional arrangement between competition authorities and financial stability authorities related to the M&A. And I remember that there is a big heterogeneity in the sense that in some countries, the financial stability exception allows the merger to go through without the competition authority being included, and some other jurisdictions not. So do we need to sort of find a more common approach to the relation between financial stability and competition in Europe? Because otherwise, again, the feasibility of the merger may depend very much on the institutional arrangement of competition authorities.
Yeah, I think we have exhausted the first list that I could, and we have exhausted our time. I'm so, I would say, I'm really devastated that we can't really enter into the debate that is luring. I mean, there are so many interesting aspects that have been mentioned, which I think you would like to have taken up or will take up in future work.
Should we briefly answer?
Okay. Yes, we can. Okay. So okay. If you are like speaking for the organizers, why don't we have a last comment by everybody? And maybe Elke, you want to start?
Well, Then
And then you say
perhaps
whatever
let
you
me
want.
start and try to answer those questions which I think relate to me. Cooperation between the SRB and the national authorities, first and foremost, during a resolution, there has been, or those cases I have experienced, there has been excellent cooperation between the supervisor, the resolution authority, national as well as SRB. But the legal framework is pretty clear. The SRB takes the resolution decision to be implemented by the national authority. Now you need to consider in Europe, you know it better as well as I do, that to implement a decision, you need to know the national law. So it's a very smart idea that when you draft your decision, you already reflect on the national law because you want it to be implementable. Or, to take it one step further, what the SRB at least till end of, is doing, I expect that hasn't changed, is that it has prepared for all member states so-called national handbooks to say if you have to write down equity, how does this work in a different country? So that you have all this knowledge, at least in principle, and then you check it against reality when you really need it. Second, to attract international bidders, and you mentioned Banco Popular, and as it's public knowledge to simply answer, in the case of Banco Popular, this was a slow-burning crisis for a long time because the bank basically tried to market itself. So when the SRB stepped in, we looked at their marketing process and then approached those banks that had at least indicated beforehand an interest. You don't need to approach someone who has already 3 times said thank you, but no thank you. And you need to also feature in one additional point, I think you mentioned it slightly, the bidder to have a bidder does not only mean is the bank interested to buy, but it also means will they get the regulatory approval? Do they have really the means so that you are solving a problem and not having the next problem at your hand? So for me, the question of international bidders, we have never hindered any international bidders. There were just no willing bidders. There's a lot of probably thoughts about it. And I think it was you, Elena, no creditor worse off, for sure. And no creditor worse off is a bit, I would call it the corrective measure also against excessive profits. And the most important one is try to have more than one bidder. Try to at least also give your last bidder the feeling that he cannot be sure that you follow his ideas. So it's normal marketing.
Yes. So to Nicolas, yes, we probably don't need a legislative change to improve the coordination between the resolution authority and the supervisor. You want to be sure that it happens early enough. So it's not about, and for that maybe even a legislative initiative could be useful to set up the right process. It's not about, of course, the resolution authority can trigger, can call for resolution, but you want the right process with information exchange early enough and so on, and that may be mandated by a regulation. If it's not done by itself. So that's what I wanted to say. And also a lot of the comments have to, are kind of all toying with this fact that Elke put very simply, which is that the alternative is between European resolution and national insolvency. And so it's a coordination not only between the SRB and the ECB, or maybe it ideally should be a coordination between SRB, ECB, and some European Treasury, if you want to go all the way towards the US model, which we don't have. It's a coordination with 27 national authorities. And so that makes it very difficult also to plan, because you want to know when you trigger resolution, you want to know how insolvency would look like in national law. That's an additional layer of complexity here. Second, on the financial stability exception, yes, I think the framework depends on the countries, and certainly it would make a lot of sense to have a unified, a unified framework, which means no financial stability exception ever. I've seen that Belgium wants to have a medical exemption. I'm sure France would be very happy to have an agriculture exemption and a culture exemption and so on. and then you at the end you don't have the merger regulation is dead, right? So there should be also some harmonization there. And to Xavier, yes, I think no international bank will ever come, probably. Still, you can have international investors, investment funds. You can have US funds, so maybe not in all cases, but in some cases. And we had that in Greece, and we had that in Portugal, and so on. So I think that's something that you could try to develop. And maybe one last word, that hasn't come in the discussion, but there are lots of thoughts on how social media and modern communication can make bank run even faster, and triggered also by the US developments, which is going to make everything we've been discussing today even worse. Just concluding with that.
Thank you for your comments.
On the excessive profits, profits is easy, right? And we've seen that there are profits. Excessive is normative, right? And so this is tricky to answer. I think I agree that there should be profits. Otherwise a bank manager cannot sell it to their shareholders, and they also have to have in mind the bad state, right? It's not always a good state that the bank is evolving good over time. So yeah, there should be profits. What is excessive is not to answer for me. I think maybe this is rather for politicians. Yeah. Okay. Yeah. Okay. Yeah.
So I see. Yeah. And one last sentence from.
Well, so I guess I won't say anything about excessive profits because my colleague did it. I just want to comment on the commenters. Because both of you stressed that cases where you have an acute liquidity crisis is very difficult to deal with. Yeah. And this is also borne out by the data. So, as you know, in 2022, just after the start of the war between Ukraine and Russia, there were two subsidiaries of Sberbank resolved in Croatia and Slovenia. And there you had extremely high accounting profits of about 10% of the assets of the acquired bank. But it all happened within a week, right after the start of the war. So I suppose there were very few options. So I don't think there's any blame to be attached here to the SRB for this.
So, there's much is open, many questions are open. But I think this was a fantastic contribution to this topic. And I want to thank you, Elke, Benoît, very much, and both of you for presenting. So,